Hey there, I'm Nicole King. I'm the broker owner of 41 Realty Group in Billings, Montana. Back again with Ian Ullman with Guaranteed Rate. There are a lot of different options for buyers when they're thinking of where to get their mortgage from. There's banks, there's mortgage companies, there's credit unions. What is the difference between each of those types of institutions? And yeah, just your thoughts on
Yeah, definitely. So the vast majority of mortgage lenders in our market, especially, sell those loans on the secondary market. Fannie Mae, Freddie Mac for conventionals. Ginnie Mae is a common government investor for government loans.
Sure.
Not a government investor, but for government loans. And so, whether it's bank, credit union, or mortgage company, the vast majority of those loans are going to have very similar underwriting standards.
Okay.
Across the board, because that's all based on the investor, based on Fannie Freddie's guidelines.
So those are the requirements that the buyer needs to meet or the loan needs to meet. Those are all pretty much going to be the same.
Yeah, that's going to dictate documentation requirements, occupancy requirements, and how to prove all those things.
Okay.
Each institution, actually, whether a mortgage company, bank, or credit union, can also have these things called overlays. We talked about it a little bit in a video last month.
Yeah.
Where, again, say for example, the Fannie Mae guideline is credit score of X. If a lender wanted to be more conservative, they could have have a higher credit score requirement as an overlay.
Okay.
So that's where you'll start to see a little bit of difference. Also, each institution has different relationships with different investors.
Okay.
So whereas a regional bank might have a handful of investors that they sell those loans to, whereas a credit union or a larger institution or brokerage might have other investors who have similar but slightly nuanced requirements. So that's where you'll start to hear some of those differences from people in their buying experience. A lot of that stems back to what's the documentation requirement from the investor.
Okay.
And then on the mortgage company's side, where we live at Guaranteed Rate, we have all of those things as well. And then you'll also have, for loan situations that don't quite fit in those typical boxes,
right.
There's relationships with either large institutional investors where we can do it as those would be called a correspondent loan.
Okay.
So just because I have a conventional loan doesn't mean it has to go Fannie Freddie. There's a bunch of other investors that will also do conventional loans. And then we also have brokered relationships where we actually would broker that loan for one of those lenders, where we're more of the middleman and that institution is technically the lender on the loan.
Okay.
Little nuance, but for the most part, it's going to be substantially similar. Little differences amongst the different institutions and investors.
Okay. Well, hopefully that clears it up for you guys to know the difference between bankers, mortgage companies, credit unions. Bottom line is, if you're looking to get a home mortgage, check with multiple types of lending institutions. Make sure you're getting the right fit for the type of loan, that your loan originator knows all the details about your personal situation so they can find the right fit for you, and make sure that you really fully understand the product that you're going to be receiving. So thanks, Ian. If you guys have any other questions about lending, shoot us a message, put a comment below, let us know your questions. We're happy to answer them. See you in the next video.